Hi, welcome to Chapter 10. So we're going to be talking here about long-term debt. Most businesses finance their investing activities with long-term debt. It's kind of like you wouldn't buy a house with a one-year mortgage. Liabilities that go longer than a year, typically long-term liabilities. Long-term debt agreements vary with respect to requirements for paying interest charges and repaying principal. Principal is the amount that you're borrowing. Loans that require payments of principal and interest at regular intervals, those are called installment notes. That's where you pay the same amount every month. Think of your car or your house payment. Those are installment notes. And what happens with those is when you make the payment, you're paying the interest that's due for the period since the last time you made a payment. You're also making a reduction of the principal, the amount that you owe. So our loan agreement here has an interest rate of 9% and requires Blair to pay 5 equal installments of $25,709 on December 31st of year 1 through year 5. The amounts in Exhibit 10.1 are computed as follows. So we're going to be shown some of the columns. So I'm just going to flip through this for a second. So let's go cardinal rule number 1, right? Read the question 3 times or at least twice. So let's see what we've got here. We have a loan agreement. We're borrowing some money. The interest rate is 9%, and we're going to assume that's an annual rate, which is what we always do unless we're specifically told that the rate is only for a certain period of time. We're going to make 5 equal installments or payments of $25,709 at the last day of the year, December 31st, for 5 years. So this is a 5-year note, which makes it long-term, right? We're paying 9% interest. We're making payments of $25,709 each year. Now, column D is the interest expense column. And the way we're going to calculate that is we're going to take the rate of interest rather of 9% and multiply it times the principal balance at the beginning of the year. The principal repayment column, column E, is going to represent the difference between the interest that's due and the amount of the payment, the $25,709. There will be a difference, and that difference will then go to number 3. It'll be subtracted from the beginning principal balance to give us an ending principal balance. Obviously, picture is worth 1,000 words. So here you go. So in year 1, we have a balance of $100,000 because that's what we borrowed. We make a payment on December 31st of $25,709. That's the agreement. The interest is going to be, for column D, 9% of the principal balance on January 1st. So in this case, it's $100,000. So 9% of $100,000, $9,000. Now, subtracting the $9,000 from the payment of $25,709 leaves a principal repayment amount of $16,709. So we're going to subtract that $16,709 from the beginning balance of the mortgage, $100,000, leaving us $83,291. That's our ending principal balance for year 1. That's also going to become the beginning principal balance for year 2. And we're going to go through the process again. So we make a payment of $25,709. Our interest is now going to be 9%, not of $100,000, but of $83,291. Our interest is $74.96. Subtract that from the payment of $25,709, leaves a principal repayment amount of $18,213. Subtract the $18,213 from our beginning balance of $83,291, leaves an ending principal balance of $65,078. Year 3, that becomes the beginning balance, We make a payment of $25,709. The interest expense is now 9% of $65,078. That comes to $5,857. Subtracted from the payment of $25,709 leaves $19,852. Subtracted from the beginning balance of $65,078 leaves an ending principal balance of $45,226. That's the beginning balance for year 4. We do the same process again. Interest is $4,070 and ending principal is $23,587. Now you'll notice what's happening here. Over the years, the amount of interest expense is going down and the amount of principal repayment is going up. This has in the past caused consternation for taxpayers. Why, you ask? Because taxpayers they still are, but most people aren't using it anymore, were allowed to reduce their taxable income by the amount of mortgage interest they were paying. That was the incentive for people to buy homes, or one of the incentives. The problem was on a 30-year note, when you get to year 20, you have very little interest expense left, and most of what you're paying is a principal reduction. So you're losing all your tax deduction for mortgage interest. And people started to see that their tax bill was going up and they got kind of ticked. But there's nothing you can do. It's the nature of an installment note. All right, so recording an installment note is pretty straightforward. On December 31st of each year, we're going to have a journal entry that's going to be a debit to interest expense. The first one is going to be $9,000. We'll have a debit to installment note payable, because remember, we're making a principal reduction. So that was $16,709 in year 1. And then, of course, a credit to cash of $25,709. This journal entry will be repeated 5 times, right? Each year of the note. Notice down here on the statement of cash flows that the principal reductions go to financing activities, the interest reductions go to operating activities. Line of credit. It's another way for companies to get long-term borrowing. And a line of credit is simply where a bank says, we're going to set aside X amount of dollars, and you can use any or all of that at any time during the year and pay it back when you want. So as opposed to an installment note where you're taking X amount and you're paying it back over this period of time, a line of credit is very flexible. You're only using what you need, and you're only paying interest on what you need. Typically, it's the credit agreements usually specify a limit on the amount that can be borrowed. And banks, in my experience, and I was getting lines of credit for over 20 years for companies, typically the bank will base its line of credit, at least for a small and medium-sized company, on the amount of accounts receivable that you have that's less than 60 days old. Anything over 60 days, they won't loan on. And then maybe they'll pay you, depending on the profitability, the financial stability of the company, they'll pay anywhere from 80 to 95% of that amount. So if your accounts receivable are, say, 100 grand, and you have $90,000 that's 60 days or less, maybe they'll pay you 80% of the 90, so you'll get 80% of what's outstanding. Interest rates on lines of credit normally vary with fluctuations in some designated interest rate. Benchmark, LIBOR is a good one. That's become more and more the standard. Lines of credit typically have 1-year terms, but lines of credit, as long as you use them, pay them back, and you don't pay them back late, you pay them back on time, they'll be renewed from year to year. They may take a look at the accounts receivable to vary how much is available on the line of credit, but it'll pretty much be renewed as long as you're a good credit risk. So this is kind of the way a line of credit works. So in March, the company borrowed 20 grand. So now the loan balance is 20,000. The interest rate for the month is going to be 9% divided by 12 months. So multiplied times 20,000 gives us interest expense for the month of $150. Now in May, they're borrowing 50, so now the balance is $100,000. You'll notice the interest rate changed. So maybe this particular line of credit has different rates based on the amount that's been borrowed. Because notice in June, we paid $10,000 down, the balance goes to $90,000, and now the interest rate is 10%, not 10.5%. And you'll also notice that as the payments go in, the amount of interest is reducing again. So they started borrowing in March, the borrowing ended in August. They didn't need it anymore. Here's the way we record a line of credit. It's real simple. We get the cash, we debit cash, credit. Now they're using note payable here. I might call the account line of credit, simply to denote the difference between a note payable, which is a standard loan, and a line of credit that's going to be going up and down. Interest expense is debited for March 31st when we pay for the interest for March. And then in April, we took another 30,000, so debit cash, note payable again. So this is the way a line works, and this is the way I used it. Say I got to pay bills this month, the bills on Friday. I'll call the bank and say, hey, can you guys take $250,000 off the line and put it into my checking account? So the bank takes $250,000 from the line of credit, puts it into my checking account, and now the interest starts to run on that $250,000. So maybe I get some big payments from clients the following Tuesday. I call the bank, hey, can you guys put that $250,000 back to the line? So they're going to take money out of the checking account and they're going to put it back into the line of credit. And now they're going to calculate how much interest I owed from the Friday or the Thursday that I called to get the money and the Tuesday that I paid it back. So now we're going to talk about bonds. Bonds are a big deal when it comes to companies borrowing large sums of money over a long period of time. And most of you you're familiar with the word bond, but you might not be sure exactly what they are and how they work. A bond is a certificate. When a company wants to borrow money, they sell these certificates. Bond certificates typically have both what's called a face value, that's the amount that's printed on the bond, not necessarily what you paid, but it's what you're going to get back when it matures. It's also going to have a stated rate of interest. So there's going to be an interest rate on the bond. The seller is called the issuer, the bond buyer is called the bond holder. Again, face value, that's the amount that the bond is for. And again, it's not necessarily going to be what you paid for it. It's what the company is obligated to pay you back when the bond matures. And the stated interest rate is obviously the printed interest rate on the bond. Bond financing offers companies the following advantage. So there's some reasons, specific reasons, why companies will sell bonds as opposed to going to a bank to borrow the money. Bonds usually have a longer term. The bank may say you can have a loan for 3 years because that's what they think they want to give you. Bonds could be 5 years, 10 years. Governments typically 30 years. So it allows companies to implement long-term strategic plans without having to refinance the loan. And number two, bond interest rates can typically be lower than bank interest rates. Because remember, the bank has to make money on the loan. So if the going rate of interest is 8%, maybe the bank is going to charge you 10%. Companies, because they're selling the bond, they set the interest rate, and they can set the interest rate lower. Bonds may be secured or unsecured. And security simply means collateral. If you're familiar with the word collateral, it's an asset that you put up to secure the loan, what you're borrowing. So, for example, when you take out a mortgage, your mortgage will have as collateral the house that it's paying for. So if you don't make the payments on the mortgage, the bank takes back the house. Now, obviously, the bank doesn't want the house. They just want their payments. So that's what a secure bond would be, would have an identifiable asset that secures it. Unsecured bonds are also called debentures. They have no backing. Their backing is the financial stability of the company. And bonds are rated. There are bonds, some bonds are really good, some bonds are not so good. They're rated based on the financial stability of the company. And they're rated by these three companies, Fitch, Moody's, and Standard & Poor's. And they give a rating to the bonds. It helps investors decide whether or not they want to invest in the company, and also whether or not the rate they're being paid is a complement to the risk that they're taking in loaning the money. The highest rating a company can achieve is AAA. Next is AA, and so forth. Bond issuers try to maintain high credit ratings because obviously lower credit ratings require them to either pay higher interest rates or sell their bonds at a discount. And we're going to talk about discounts later on. So our example here is Marsha Mason. Isn't she an actress? Old actress. Marsha Mason needs cash to seize a business opportunity. She offers to sell her friends bonds with a 9% stated interest rate. The terms specified making interest payments in cash on December 31st of each year, 5-year term to maturity, and pledging land as collateral. Mason issued the bonds in exchange for cash on January 1st. So, cardinal rule number 1. Let's read it again to make sure we clearly understand the basis of what's going on here. So she needs money. She's going to do something with it. It's a business opportunity. She's selling bonds. The bonds have a stated interest rate of 9%. The interest payments are going to be made on December 31st each year of a 5-year term. So she's making 5 yearly interest payments at 9% of the face value of the bonds. And the collateral for the bonds is land. So obviously she's borrowing the money to buy the land. So event number 1, I issue the bonds. So she debits cash, credits bonds payable. We now have a liability on the books, a long-term liability called bonds payable. And on the statement of cash flows, we have a financing activity. Next event, we're paying cash for the interest. So it's time to make an interest payment. We debit interest expense for $9,000. That's the 9% of $100,000 that was borrowed, or for the face value of the bonds, sorry, and credit cash for $9,000. And notice, interest is considered an operating activity on the statement of cash flows, not a financing activity. And this obviously, this journal entry will be repeated every year that the interest payments need to be made. So years 1 through 5. When we get to the end and the bond matures, we're going to pay back $100,000. That's the face value of our bonds. So we debit bonds payable for $100,000. We credit cash. Again, that is a financing activity. And that's pretty much selling a bond at face value. Straightforward stuff, not very complicated accounting. Here's the way it looks. Here's the way it looks on the financials. So on the income statement, you see interest expense for $9,000 a year for the 5 years. Pretty straightforward stuff. We go to the balance sheet, and we see bonds payable, 1,000, 100,000, 100,000, 100,000, and 0. This differs from that installment note, doesn't it? Because we're borrowing the 100,000, but we're not getting any, we're not paying any principal, excuse me, principal reductions here. We have the 100,000 outstanding every year until we pay it back, which is why the interest is the same. Note the interest stays the same here. On the installment note, the interest was reducing because we were making principal reductions as well. Not so with bonds. So now we're looking at a different situation. Miss Marsha Mason is offering a 9% interest rate on her bonds, but the market is paying more. So people who are investors are saying, hey, you're only paying 9%. I can get 10% over here, or I can get 9.5% over here. What can you do for me if you want me to buy your bonds? So what Mason says is, I'll sell you my face value $100,000 bonds for $95,000. So let's see what that means. Let's see, if it's the face value is $100,000, that means bonds payable is $100,000, which means that when they mature, we're going to be paying, she's going to be paying back her bondholders $100,000. But she's only getting $95,000. So they're getting an extra $5,000 here. Mason's going to consider that an additional $5,000 of interest. And that additional $5,000 is called a bond discount. Why discount? Because you're discounting the face value of $100,000 to $95,000. Mason's friends agree to buy the bonds for $95,000. Cool. Mason must still pay cash of $9,000 a year, right? December 31st, year 1 through year 5, even though she only borrowed $95,000. So she has what we're calling here an effective interest rate that's different than the stated rate on the bond. Right? The stated rate is 9%, but the bondholders are getting more than that. Mason will have to pay back $5,000 more than she received, right? She got $95,000. She's paying back $100,000. The extra $5,000, as I said before, is additional interest, and we're going to call this the bond discount. Although the $5,000 of additional interest is not payable or paid until maturity. So in other words, because it's built into the face value, she's not going to get that additional, they're not going to get that additional $5,000 until the bond matures and they get that check for $100,000 representing the face value. Because of the matching principle, Mason has to recognize additional interest expense each year that the bond is outstanding. The actual rate of interest that Mason must pay is called the effective interest rate. Rough estimate of the effective interest rate for the discounted Mason bonds is 10.5%. How do we get that? Well, we have a $9,000 annual stated interest, right? That's the 9% of $100,000, plus the $1,000 of annual amortization of the discount. Right? We're going to take that $5,000 and amortize it, or divide it by the number of years of the life of the bond. The bond has 5 years, so 5,000 divided by 5 is an additional $1,000 of interest per year. So the interest is actually 9,000 plus 1, or 10. So 10,000 divided by 95,000 is approximately 10.5%. That's the effective interest rate. And we have that effective interest rate because we sold the bonds at a discount. Common business practice to use discounts to raise the effective rate of interest above the stated rate. You have to. Bonds frequently sell for less than face value, and when bonds are sold, ladies and gentlemen, they are typically sold at what's called a percentage of the face value. For example, Mason is selling their $100,000 bonds for $95,000. So they sold those bonds at 95. That's what it's called, because it's 95% of the face value. Because Mason must pay the face value at maturity, the $100,000 face value of the bonds is recorded in the bonds payable account. So we now have a journal entry to a contra liability account. It's called discount on bonds payable. And we remember that from chapter 7, a contra account means that this account has the normal balance that's opposite of the normal balance of a liability. So since liabilities have a normal balance of a credit, the normal balance of a contra liability, in this case bonds payable or discount on bonds payable, is a debit. So $100,000 credit minus a $5,000 debit for discount on bonds payable gives us what's called the carrying value of the bond of $95,000, which is what we got paid, right? Now the problem is that that carrying value has to equal the bonds payable account by the time it matures. So what we do is when we make the bonds with a face value are recorded as a debit to cash for 95 grand, a debit to discount on bonds payable, remember it's a contra liability rather, discount on bonds payable of 5,000, and the credit goes to bonds payable of 100 grand. That's the face value. Now we have to recognize interest expense. We're making payments here. So we have a payment of cash credit to $9,000 to the bondholders. That's the interest that they're expecting, 9% of the $100,000 face value. But we're also recognizing at this point the amortization of the discount on bonds payable. So that's a credit of $1,000. So 9 plus 1 gives us a debit to interest expense of $10,000. It's also going to change the carrying value of the bonds when we record this transaction. And we'll see it in a second. So at the end, paying off the bond liability is just a debit to bonds payable, credit to cash. Notice again, the interest goes to operating activities. The principal goes to financing activities. So here's our financial statements with the discount. Notice, interest expense is $10,000 a year. It's the $9,000 plus the amortization of the discount. And notice what happens to the carrying value here. In year 1, the carrying value goes from 95 to 96. In year 2, it goes to 97. In year 3, it goes to 98. And look what's happening to discount on bonds payable. It's going down by $1,000 a year. In year 4, it goes to 99. And in year 5, the discount disappears, which leaves us only the bonds payable at $100,000, and that gets paid off. And the bond matured. All right, I will see you in part 2